Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today on Thursday, July 31st, 2025. All right, let's share some disclosures to begin. I'm going to also share a few um, items as usual in the chat. And I also want to remind everyone that TradeStation is offering something new here. Let me just tell you that TradeStation is preparing to launch Titan X, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. Titan X will be available to customers as a beta soon. If you're new to TradeStation, you can join the wait list at tradestation.com/Titan-X or see the description in this video. All right, so great to be with everyone. And today we did not do a rundown. We're actually updating the blog, so the blog is not we're not doing anything new on the blog for a week or two, but we'll be back with it soon. So today, though, the title of our webinar is the gold rally over? So I think that's one of the things we wanted to start with. But overall here, as we look, I want to mention that right now, we're ending an interesting period in July. We still have more earnings to go and stuff, but a lot of the big stuff has happened. So I want to just show a few things here overall in the S&P. Now, I do want to mention that we do have at this point in time, um, seasonality in some ways can get worse from here. So I think it's important to realize that July is historically the best month. August is a little worse, and then September is historically the worst month in the market. So we're now ending what is considered the best month. Also, as you look forward, in many ways, Microsoft and Meta were two of the really big names, and I think that now puts us in a spot where people may see as some of the news having happened. I don't want to be bearish by any stretch, but I want to just emphasize that certain things have now happened to put us in a spot where the situation might be you know not as favorable. So the S&P, opened an all-time high, failed to hold so far, which is also another kind of a little bit of a sign of some fatigue. I don't want to overstate it because there's a lot of positives happening in the market here. So like we don't have a blog post today, but I am still going to go through the calendars and things like that. So let me just actually show you here that what's interesting that I'm noticing is we're seeing on this daily chart more solid candles, which means it opens at a high and fails to hold. Now, this was like 8 straight days up, and now we open high, close below the high. We close below the open up, close below the open. Now again, so these kind of candles are starting to give us some signals, some potential signs of people selling the strength. I think that's something to be aware of. Now, another thing that I'm watching as a level is right here at 62.82, which is the low of July 22nd, which is a weekly low. Underneath that, we can look down to 62.01, which was also the weekly low back on July 16th and also a weekly low on July 7th. So from my view here, these are the two kind of levels. The low of July 16th, that was when everyone worried that Jerome Powell was going to get fired. We had that crash, that little mini intraday crash, and came back. And then we have basically a weekly low at 62.82. So I'm watching 62.82 and 62.01 in the event of weakness. Now, this chart is one of my favorites. I show it a lot. And basically, we can see this shows the RSI. I call this RSI cooking. I have my, 1 second, let me silence my alerts on my other computer. Basically, I call the RSI kind of cooking when it goes up and it gets overbought and then it just kind of stays up there for a while. And now we've seen this, and it's a sign of lingering ongoing strength. Now, in my view, in some ways, this could now maybe have run its course. I'm going to show you more history on this. I'm going to go back to 5 years of history on this chart. And basically, when we see this happen, especially the first time, it's not a bearish signal. If you're in the context of an uptrend. So basically, this is an all-time high with RSI overbought, continues. Now we see it again, and it kind of stalls and same thing. So now this is more in the ballpark of giving the overbought condition that is potentially sort of more of a potential negative. And I think it's important to realize that in and of itself, RSI can it's like valuation. If you're traded at a high multiple, it means people think things are bullish, but then at the same time, that becomes a liability later when sentiment starts to turn. So I want to just kind of point that out here, is that this is now getting more in the spot where this could be more of a sign of things kind of petering and getting more tired. I mean, you can see that, this can get, like, this is what I mean. The first touch, can have continuation. The second touch can be more toppy. We see that last July of 2024. We've seen it at other times. The first touch can be bullish, continuation. You touch it the next time, it gets toppy. So we've now touched it the second time as we come toward the end of a positive seasonal month of July. Also, I'm not going to bring it up on this chart, but the 10-day moving average on the S&P 500 has been rising for 41 days. It has only, that's the longest streak since early 2024. And in the last decade, it's only risen 45 days or more 4 times, and it almost never rises more than 50 consecutive days. So on this chart, I do have the 10-day moving average on another chart. Most people don't do the 10-day, but I really like it on the S&P. And so, I find it's one of these things when you can touch it a few times, and that's kind of nice. You see, we've just been rising steadily. But then the problem is that when you start touching it too much, it starts to be signs of being tired. So I want to just point out that often what this will do is this can, you know, just flatten out for a while and have periods of consolidation. So the thing is, if you have that overall positive view, people might look for some chopping in here. The 10-day would flatten out, some period of languishing, and then, whatever you want to take it from there going forward. And, I think that these very unclear, because the Fed, in my view, is not necessarily the real sort of thing that could be bearish. It's a fact of whether or not the inflation really does come through, and then also the potential for some of the geopolitical things that I'm going to briefly touch on, because I think that it's an unusual sort of combination of things right now. But the fact that 10-day moving average has been rising for 45 days is also kind of giving us a little bit of a sense of this short-term trend is no longer so young and sprightly. It has run its course, or maybe not run its course, but it has run, and maybe it has run its course, and that's kind of the thing that you got to be careful of. All right, so now I want to look at the title of our webinar today, which was whether if the gold rally is over. Now this is the weekly chart of gold on TradingView. And I thought it was interesting here. If you look at gold, is it basically the last time it made a high was over 3 months ago. Interesting, isn't it? Gold has been stuck in this range here. And there's different ways you can play it. I've honestly found that these converging ranges are not enormously useful. They often just resolve into, sideways ranges, which are more of a serious, kind of reliable sort of thing. But, it may actually suggest at this point that tests back down toward 3,200 or 31, 15, whatever that was back there in mid-May. People might look for this now to stagger. Now, I want to point out that on our webinars, we have been talking about this for a couple of weeks now. We've been talking about the dollar index. And if you look, the dollar index completed this Elliott wave to the downside. And so I think it's interesting here, that from my view, the thing of, I'm not a big Elliott guy, but I do believe that it does have some use to see sometimes when a move has completed. I don't go much beyond that, but when I see something that is a clear sort of move, and I can now say, I use it more as a standing check, so I don't push on a string. If I see something that's run a certain direction, I'm like, all right, the Elliott wave has completed, and I'm not going to keep pushing on that string. And in this case, I see in some ways, like this is what our signal was that it had completed the downside move. And then if you look at it on the daily chart of of the dollar index, I mean, this is a weekly low, but it makes this higher low here. And it's also interesting. So I think overall, this is telling us here that we now have a period where this was a crowded bearish trade in the dollar. And it's hard to keep pushing on it. And at this point in time, that trade is kind of, potentially gone for a while, and that has implications for gold as well. So I think we need to kind of realize that. I also, think it's really interesting. I'm going to bring up one other thing here that I thought was interesting. I watched Jerome Powell yesterday, and he said certain things that I was really surprised by what he said. It was he said the word doubt. I'm going to keyword search for the word doubt. He said, what we're trying to do is accomplish in a way that is efficient. But he said, in the end, there should not be any doubt that we will do what we need to do to keep inflation under control. So, and he said other things like this. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. And he basically said, we're going to, we're going to fight inflation. And I mean, I think he kind of said that, we don't care if we hurt the job market. We don't care if we hurt the economy. He's talking a tough game. Now, in many ways, if he knows he's out next year, he has an incentive to be tougher. But I want to just point out that this language was actually pretty strong. And I think in many ways it's just to point that out, there's another thing here that is potentially not a wonderful sort of scenario if you're long gold. So we've been just noting here that gold has been staggering. And when you overall think about it, the S&P has been going to new highs. The unemployment is low. The economy, in varying degrees, has been strong. And if you look at it here, gold, since even the beginning of the year, I mean, it went from 2,600 to to 3,500. Basically this year. And if you go back to the beginning of last year, I mean, it's up like more than 50% from the beginning of last year. And in that time, we've gone from being super dovish in our expectations of rate cuts to being much less dovish in our expectation of rate cuts. So I think there's a lot of, of thrust in here. The key thing is that a lot of this was caused by a secular return of central banks buying gold. It was a big thing. It happened. But the question now is, that could have just been a generational reset when they basically said we got too heavy on dollars, too heavy on fiat currency, and we're going back to a reset. And it's possible, just assuming it's the beginning of a new trend, that might be a big assumption. It might simply be they were too light on gold and they reset and now maybe it's over. So I want to just kind of point that out. There are things about gold here that you can make a positive argument at. But I think we also have to realize is that these conditions increasingly don't favor gold, from a certain perspective. So I thought that was kind of interesting. Now let's look over here at the personal consumption expenditures. This is the PCE inflation. This is on the Fred tool. I'm going to edit the graph and I'm going to go to percent change from a year ago. And what you can see is that we have been pretty much, this is the data came out this morning, we've been stuck here, of 2.7, 2.8. The Fed wants it to be back down closer to 2. So if you look historically, basically coming from 1996, through basically 35, for 25 years there, we basically had a period during which PCE was mostly under 2%. Basically between 2004 and 2007, it went above. And so now it's interesting. The high from 2006 is more or less where we're holding there. Now, I don't believe in technical analysis on economic data, but it is interesting to see that the data is now kind of stabilizing and we're putting in a low above what used to be a generational high. So if the Fed wants to see inflation back to 2% here, this is also something that is not great news for them. But with unemployment low, it also keeps that sort of narrative toward not cutting rates. So I think that also is something that is not a wonderful thing for gold overall. Today we have the employment cost index for Q2. It was a little higher than expected at 0.9%. Jobless claims still continue to stay pretty low. And so I did put these things out there because, from my perspective here, you do have a sort of thing here where the dollar, gold here has not made a new high in over a quarter. The dollar is showing signs of moving higher. Another thing I wanted to show you guys on my Monday webinar, this is the TLT, which is the bond ETF. And, I think it's interesting here to look at this because the bond ETF has actually made, I'm sorry, where'd it go? I'm using TradingView because some of these things tie into it. But basically our Monday webinar, sorry, this actually should be like this. Anyway, this is not well drawn, it's the wrong color, but the key thing is that basically we're seeing a higher low here on the weekly chart of the TLT, which is bond prices, which is the opposite of bond yields here. So when you look overall at this whole scary scenario we had of the world dumping treasuries and and gold rallying and all that stuff, the D dollar, all these sort of things that happened in the first part of the year. Um, the point is that there are signs of that reversing, the dollar moving higher, the yields, the bond prices moving higher, making this kind of rounded bottom. And then you look at the 10-year treasury yield here, essentially just in this range that we've talked about a lot, not conclusively, shooting to the upside. This is exactly as kind of counterintuitive as it might be. This is exactly what we've been kind of identifying, which is the dollar can go up, yields can go down, and that environment is actually structurally better for stocks, and it's not really good for gold. So the curve flattening says, all right, we actually have confidence now that Powell, by keeping rates higher, is going to crush inflation, and that's going to bring down the long end of the curve, and that's a positive for stocks. And what it also means is it keeps the dry powder for when claims go higher, 250, 300,000. We start getting those claims. We start getting negative retail sales. We start getting something closer to a real recession. Then the Fed can come out and start cutting rates. And that is where you want to be if you're in a good environment. And honestly, that's exactly what the late 90s were. The late 90s barely had any rate cuts. We had basically, rates that were kind of high. It was a high real interest rate. And basically the multiples stayed high because you had real organic growth in growth stocks. And then what happened when the Fed started cutting was that then you started getting the explosive kind of continuation. So I think we have to realize here that this environment is structurally positive for stocks, but that environment that's structurally positive for stocks, don't forget, that's when gold went to 300 in the late 90s. Gold in the late 90s had its worst period of time. So I want to just kind of point that out here, that if we're in a, so these things all are kind of, pointing toward an argument here that there is some potential, reason for people to not be as enthusiastic about gold for the next quarter or two. So I wanted to mention that. Now, however, there is a flip side to that, and I don't even really know how to get into this too much because it's not market stuff. But I think if you look right now, we are kind of in a spot where there are some, I think, growing geopolitical risks. And the trade thing is not really going away. We have still this. I mean, there have been these deals, but this thing Trump is now saying about Russia is potentially really could turn into something that could be bad for stocks. I mean, it could be problematic because if they decide they want to basically, if Trump stands by what he says and he starts putting sanctions or higher tariffs on countries like China because they're trading and they're buying Russian oil, that takes what was a progress on trade and it just throws it right back into chaos. So what I see actually happening is that we actually see now geopolitical stuff is kind of merging with trade stuff, and that's not really great. It was, if we're talking about trade and trade deficits and all that stuff, then that's the conversation. The market will then focus on that, and the market will ignore geopolitical stuff. But when these things start coming together, that becomes kind of risky. And then the other things, so you basically have, kind of three issues. Well, then you also have the potential thing in the Middle East. So you kind of have Middle East, is there going to be another conflict? Is, what's going on with all those things? So you have basically the Russian situation with its conflict with Ukraine, which could result in sanctions on China, which, or increased trade conflicts with China. You have the ongoing uncertainty of the tariff stuff right now. Will these things be resolved and all that stuff? Then you have also, the Middle East situation, and these things have been separate. And I just want to point out that I see the potential. If you look at the news in the last couple of days, they seem to be converging into one thing, and that's a little bit worrisome. So I didn't want to point that out. I'm not going to try to make any big predictions or anything, but I think it's just interesting to see that the market has kept these things isolated, and if they do kind of come together, it also creates more of a potential real macro geopolitical kind of fear. And so I just think, especially the thing of the idea of we're going to punish, China and India for what Russia's doing, it actually puts Trump in a spot now where it's harder to back down because it's not about what China does, it's about what Russia does. So not going to make any kind of hard predictions, but we just kind of see that we're getting into a period now it's not as strong, and then these other potential risks are kind of, potentially coming together. However, Let's get back to stocks because that's what really we care about. S&P now kind of went to its low of the day. We might have just had another, you know what? I think we just had another bearish outside day here. See, let's see. The low right now is 30. The low 2 days ago, yesterday was 36, and the low today was 34. So we have now a bearish outside day. We have a bearish outside day here, and we have a bearish outside day here. So it's almost like a megaphone when the price action widens, which is also kind of a sign of increasing volatility. So I was, looking at this and seeing this at the beginning of August is something that is not, a hugely, positive thing, at least in the near term. I want to just point that out. I mean, we're in a situation here where the underlying situation is relatively positive, and so I want to just nothing I say should be viewed as being in any way overly bearish. I would just say that you have a situation here, and I would just go back to what I said earlier, which is 6201. That is a level maybe you're thinking about. If we get some volatility and topsy-turvy and scary this and scary that, and then suddenly you start seeing 6205, 6204, and then you start getting down towards 6201, well, remember, we bounced there earlier in the month, and that might be the sort of thing. So having these levels mapped out beforehand at a time when volatility is potentially is potentially increasing can be a useful thing to do. So those are the main things on the S&P now. I talked about all right, now, first I want to show you this very quickly. Let's go back to MT main. Actually, you know what? I think I need to show you these. I might not have shown you the standardized returns. Sorry, my routine's a little bit off because I normally have the blog post. Nonetheless, standardized returns are some of the key ETFs that we may talk about. Now, go to earnings dates here on this. If you actually go, let me just show you. Before I do that, you know what? Let's go to the CME Fed Watch tool, because you can see here pretty clearly, if we look at September, we basically went from a 75% chance. A month ago, there was a 75% chance of the Fed going 25 basis points. Now it's a 39% chance. All right. So that just shows that some of these things are kind of fading. And I think it's a combination of Powell's position, the language he said. I'm surprised those comments did not get more attention yesterday. I've heard them and I was like, wow, that's pretty intense. And then, so I think maybe the people are catching on to them now. And then let's go back to, I want to just mention this. If you go to tradestation.com and you go down, these are the articles we did last. Like, we don't have any new articles, like I said, but if you do want to see some of the work we do, it's at the bottom of the homepage here. Now, going back over to the TradeStation platform, I want to just remind you guys, of course, it is earnings season. And some of the things coming up, we're going to have, after the bell tonight, we have Apple, Amazon, and Coinbase are some of the big ones. So if you go to earnings dates, this earnings date tab, and you basically go to data, add symbol list, add the NASDAQ 100. This will help you plan for earnings season. Now, remember, if you're actually on the old blog post, this was the one from a week ago, but we do this every week. And you basically go to the top, it says downloads are available here. So the downloads then has a zip file, and in the zip file, there are a series of ELDs, which are workspaces, and then those show us those workspaces are some of the things I'm using, including this one here called MT Main. It has this tab called Earnings Date. So this is now bringing in the earnings for the NASDAQ 100, and you can kind of use this. I wanted to remind people that the workspaces we provide help you prepare for earnings season. There's a lot of useful things. It's going to take some time to populate, but it shows things like average options volume and all that kind of stuff. So you can actually, I like to hone in on the companies that trade a lot of options and look for potential opportunities around that sort of thing. So also, just quickly look at our key ETFs, because what we kind of see here is you see technology really dominating, but we also continue to see strength in utilities. I want to point that out because we've actually talked about, the breakout in utilities. We talked about it actually quite a lot on State of the Market, and it does seem to be kind of playing out as we had indicated. And you can also see here, I want to actually look at what the global has done. If you kind of look at how Brazil has really kind of fallen behind. That's a good proxy for global. I'm going to actually add something like EFA, which is another global. You can see here that there has been this shift away from global. Things like the global EFA has been weak, which is the global ETF. Brazilian ETF has been weak. So I think this is also just showing us is that, like I said, the strong dollar, this is how it's manifesting itself. So we do kind of see a broad kind of swath of information that that would correlate toward more weakness in gold. So now I'm going to get to the big news today, which is Microsoft and Meta. So what's interesting here is that basically we have Microsoft obviously breaking out to a new all-time high. They sold the open, and not a surprise. I think it's just any move like this, um, people will fade and stuff. But what was really interesting about both of these, I mean, Microsoft took its capex from 80 billion to 120 billion for the year. Meta took its capex from 62 and a half to 69 billion. So both of these are showing that there is a continued investment in AI. And I thought it was interesting that Meta in many ways proved the business case for AI. They were able to really improve the performance of almost all of their ads and everything else, and they're also kind of starting to talk about their new creative tools that people are starting to use. So we're looking at a company now that does potentially have a whole new set of assets that are starting to really come out. And so with this breakout to new highs, say for example, we do get some weakness in August, will people basically be looking for 750? And I just want to think right now, something like Meta, this could be something if it starts, stumbling down towards 750, that could be something that people might view as an opportunity. So, I mean, right now, I just think, we're entering this period of time when things are not as not as favorable. There are things to potentially worry about, and if the market really does start to price in this idea of the Fed, being more hawkish and everything else, don't forget we have Jackson Hole probably on August 22nd when Jerome Powell will give a speech. That has sometimes been a pretty bearish thing for the market, especially back in 2022. He really hammered the market. So at this point in time, as you look to August, there could be more kind of expectations of that. I don't see any Fed speakers on the calendar, but when they come out, they could be saying similar sort of things. Then we get to CPI that will be later in August and everything else. So, not to be like, anything trying to sound bearish, because I think when you look at this, there are a lot of things here that are very structurally positive. The market has made a big move, and if people are looking, now could be the time to start thinking about where would be the levels where if there is weakness and to plan ahead, where would Meta be potentially interesting? How much of a pullback would it have to look at some of these names that have been running? So I wanted to kind of point that out. Another name that was just interesting that had an interesting note not that long ago, and it just grabbed a lot of attention, is this company called Unity Software, ticker U. Um, so this was interesting. It had apparently some kind of AI tools, and there was an interesting positive bullish note on it. I don't know very much about this company, but it's interesting to see its breakout and see how it's holding. So I wanted to put that on people's radar. Another one that recently grabbed my attention is VICI. This is I've been watching this here and just see if this is a casino related company, but I'm just trying to see if we do get a breakout through these highs here, because this one has been basing for a long time. If you look at it on the weekly chart, you know, it hasn't confirmed, but if it can kind of close above, these recent weekly highs around 33 and a half, this could also be one that could extend and potentially have a lot of space to the upside. I've been watching that. Now the others that are interesting, I think is just interesting, is CEG. This is utility stock. This was a huge mover a year or two ago, and VST. These are utility stocks that have the whole AI exposure. So it's just interesting to see the strength in utilities with a hawkish Fed. It shows people have confidence the long end of the curve could be coming down. So I think at this point in time, those are some of the key things you want to be looking at. So just don't forget, the big items are tonight: Apple, Amazon, Coinbase. We have non-farm payrolls in the morning. And then next week, the big day is Tuesday when Advanced Micro and Super Micro report earnings. Hope everyone has a great day. We'll see you on Monday in State of the Market. Have a great weekend.